If you looked at the fundamentals of Polygon right now, you would assume the price is at all-time highs. We are seeing a regime change where 25.7 million tokens were burned in a single month, effectively wiping out 0.25% of the supply in 30 days. We are seeing transaction volume flip Binance Smart Chain and Base, but if you look at the chart, it's a disaster. The price just confirmed a lower low, losing a critical support structure on the weekly timeframe. Most investors are paralyzed by this divergence. Do you buy the fundamental growth, or do you respect the bearish trend? Today, I'm going to show you why I'm actually opening a short hedge targeting 6 cents, even though I believe this is the most undervalued infrastructure play in the entire market. It sounds contradictory, but in this game, capital preservation is the only thing that matters. Welcome back to Crypto Yield Pro. Let's be honest with each other. Holding Polygon lately has felt like catching a falling knife. While the broader market has had pockets of euphoria, POL is currently trading around 9 cents, sitting deep in the all-time low region. Sentiment is in the gutter. If you go on social media, the retail crowd has largely capitulated. They are chasing meme coins or whatever is pumping on Solana, leaving legacy infrastructure chains for dead. But this is exactly where we need to pay attention. The market is emotional, data is not. We have a situation where the price action is screaming sell, but the on-chain usage is screaming buy. This creates a massive inefficiency. Usually, price follows value, but right now, they are moving in opposite directions. The setup we are looking at today is rare. We have a token that has successfully rebranded and migrated, yet the market is punishing it. We are seeing a persistent downtrend since the local top of 75 cents back in December of 2024. That is over a year of bleeding. However, before we look at the charts and I explain why I'm hedging, you need to understand the sheer scale of what's happening under the hood. If you sell here without understanding the fundamental shift, you might be providing exit liquidity right before a generational reversal. Let's look at the raw numbers, because they paint a picture that the price chart is ignoring completely. First, look at the stablecoin volume. This is usually the smartest money in the room. It represents real economic settlement, not just speculation. And Polygon aggressively separated from the pack. It has now flipped BNB and Base, processing over 13 million stablecoin transactions recently. It's currently the #1 chain for stablecoin transfers. Think about that. The most used chain for actual payments is priced as crap. This volume is driving a massive economic shift for the token itself. In January alone, the protocol burned over 25 million POL tokens. That's roughly 3% of the total supply annualized. We have moved from an inflationary concern to a deflationary reality. The more the network is used, the scarcer the token becomes. It's a simple value accrual loop that the market hasn't priced in yet, and the network is handling this load without flinching. We just saw a stress test where demand surged to all-time highs, comparable to Super Bowl levels of traffic. The network capacity increased, raising the gas limit by 23% and hitting throughputs of over 1,900 transactions per second. Zero downtime. If you remember the previous cycles where chains would halt or crash under load, you know how significant this reliability is for institutional money. But here is the real alpha, and the part that nobody is talking about yet: the pivot to AI. We are seeing a surge in agent-to-agent commerce. AI agents don't care about community or vibes. They care about two things: execution speed and cost. Polygon has become the leading chain for this, with transaction costs averaging 1/10 of a cent and 2-second finality. We recently saw the first fully autonomous commerce transaction happen on-chain. An AI agent negotiated a price, bought a product, and settled the payment without a single human click. This is a burgeoning narrative. If AI agents become the primary economic actors of the next decade, they need a high-throughput, low-fee layer to operate. Polygon is quietly positioning itself as that infrastructure. Finally, looking at the payments vertical, volume jumped roughly 400% year-over-year to over $3.5 billion in Q4. This is not just DeFi speculation. This is real commercial utility. So we have deflation, record usage, and a dominant position in the AI economy. By all metrics, this should be a $3 coin. But it's not. It's 9 cents. And as a trader, I cannot trade what I want to happen. I have to trade what is happening. Let's pull up the weekly chart and deal with the reality of the price action. We are looking at a clear descending channel marked by these orange dotted lines, which has dictated the trend since that 75-cent top I mentioned earlier. Every single rally has been sold off at the top of this channel. We are making lower highs and lower lows. That is the definition of a bear trend. Recently, the price lost a key support level. We had a weekly candle close below previous structural support, confirming a lower low. This is a critical weakness. Currently, the price is hanging on to the middle of the channel. That's the white dotted line you see on the screen. It's acting as temporary support, but temporary is the key word here. If we look at the Fibonacci levels, anchored from the swing low of 16 cents in June 2025 to the high of 29 cents in September, we are well below the golden pocket. In fact, the market rejected exactly at the 1618 extension, which was around 11 cents. That 11-cent level is now our immediate resistance. The bulls have to reclaim that to even talk about a reversal. Downside targets? They are scary. The 2618 fib extension sits at 6 cents. That aligns with the bottom of the descending channel. If this middle line gives way, there is very little friction preventing a drop to that 6-cent region. That's another 30% drawdown from here. Now, let's look at the indicators. I'm watching the Heikin-Ashi RSI. After bouncing from extreme oversold levels in January, the rejection at the top of the channel nuked the momentum. The indicator has returned to oversold territory and is pointing down. However, there is a glimmer of hope. We are seeing a bullish divergence forming. The price is making lower lows, but the indicator is making higher lows, indicated by those yellow arrows. This suggests that seller exhaustion is building. The bears are running out of steam, but they haven't lost control yet. So, here's my strategy. I'm not blindly holding. I had a short-term long position that I opened in December last year. We hit our first take profit in January, which was great. But given this new lower low, I'm closing the remainder of that specific trade. I'm not going to give back profits hoping for a miracle. More importantly, I'm opening a short hedge. I'm using 1x leverage, no degens here, this is about protection. I'm entering a short here with a target of the 6-cent area. My invalidation, the stop loss, is at 12 cents. If the weekly candle closes above 12 cents, it invalidates the bearish structure, and I'll happily cut the hedge and let my spot bags run. But until we reclaim 12 cents, the trend is your friend, and right now, the trend is down. Let's synthesize this. We have a fundamental engine that is roaring, masked by a technical chart that is breaking down. This is why I played both sides. I'm keeping my long-term spot position. I'm not selling my core stack because the burn rate and the AI narrative are too strong for a multi-year horizon. If this reverses tomorrow, I want exposure. But I also respect the 6-cent target. By shorting with 1x leverage here, I'm essentially neutralizing the downside risk on an equivalent amount of my portfolio. If we drop to 6 cents, my short makes money, offsetting the paper loss on my hold portfolio. If we pump past 12 cents, I lose a small amount on the hedge, but my main portfolio appreciates significantly. If the price does manage to reverse and reclaim that 12-cent level, my upside targets remain unchanged. I'm looking at 15 cents at the top of the channel, then 20 cents, 25 cents, and eventually 42 and 60 cents in the longer term. But for now, the probability favors a test of the channel bottom. So Polygon is currently the most utilized chain in crypto that is effectively on sale. The on-chain metrics, transactions, stablecoin volume, and burn are at all-time highs. But the price is at macro lows. This is an accumulation window, but you must respect the trend. Do not try to catch the falling knife with your rent money. Wait for the reclaim of 12 cents, or wait for the bottom at 6 cents. I'll be updating this trade in real time in my free Telegram group. The link is in the pinned comment. If you want to see exactly when I close this hedge, or if I add to my long position, that is the place to be. Also, if you are looking for a place to execute these strategies, I'm using MEXC for this specific trade due to the liquidity on the pair. Link is also in the pinned comment. And if you found value in this data-driven approach, please destroy that like button and subscribe. It tells the algorithm that you prefer analysis over hype. Thanks for watching, and I'll see you soon in the next one.